Hey, welcome. Today, we're going to break down something that sounds really complicated, but honestly, it doesn't have to be private investing. We're going to explain what it means to put your money to work in a deal you won't find on the stock market. So let's just dive right in and see how you can potentially make some serious money by doing, well, not a whole lot.
All right, let me just ask you this. What if you could invest $100,000 and then for the next several years do absolutely nothing? I mean, no managing, no late night calls, no stressful decisions. It sounds a little too good to be true, doesn't it? Well, let's see.
Okay, so what if after those 7 years of, doing nothing, your investment turned into this number? $348,000. Now that gets your attention, right? Let's unpack what that number really is.
Yep, that's the potential return on your $100,000 investment all over a 7-year period. So today, we're going to show you exactly how that's possible, what your part in a deal like this would be, and, this is the most important part, how your money is kept safe along the way. And to make it super clear, we'll use a real-world example, a deal to buy a group of already successful Dunkin' franchises.
Okay, first things first. To really get this, you have to understand the two main players in any private deal. And the easiest way I know to think about it is this. In every single deal, there's a driver and there's a passenger. Let's figure out which one you are. Now, in the official lingo of private investing, these roles have names. We call them the general partner, or GP for short, and the limited partner, or LP. Sounds a little formal, I know, but their jobs are completely different, and knowing that difference is everything. So the general partner, the GP, that's your driver. This is the expert, the person with their hands on the steering wheel. The GP is the one who finds the deal in the first place. They run the entire business, they manage all the day-to-day stuff, they make every single decision, and they carry the biggest weight of responsibility. Basically, they do all the heavy lifting. And then there's you. You'd be the limited partner, the LP. So you're the passenger, and your job is really, really simple. You provide the capital, you do not manage the business, you do not make any of the big decisions, and, this is huge, your liability and your responsibility are limited. Your only job is to provide the gas for the car, the capital, and then let the driver take you where you need to go. Okay, I get it. Being the passenger might sound a little scary, right? How do you know your money is actually safe? Well, this isn't about blind trust. Your investment is protected by what I like to call legal armor. Look, this is absolutely key. You never just write a check to someone, cross your fingers, and hope for the best. That is not how this works. Every single legitimate private investment is wrapped up in a whole bunch of legal documents that are specifically designed to protect you, the limited partner. This paper trail is your shield. You can think about it in a few steps. First, you've got the subscription and operating agreements. That's the foundation. They confirm you're an owner and spell out all the rules of the game. Then there's something called the PPM, which is just a fancy term for a document that's legally required to tell you every single possible risk. And finally, every year you get a K-1 tax form, which is your ongoing proof that you're a part owner and you're getting your share of the profits. And out of all that paperwork, the operating agreement is probably your most important piece of armor. This is the legal contract that makes some huge promises. It states that you, the LP, get paid before the GP does. It limits your potential loss to only what you put in. It says you're not on the hook for any bank debt. And it legally records your ownership, tying your money directly to real, tangible assets, in this case, 18 Dunkin' stores. All right, so we've covered the legal protections, which is great. But let's be real, no investment is completely risk-free. A smart investor has to understand what could actually go wrong. So let's just face those risks head on. But first, we gotta get on the same page about what risk even means here. Risk doesn't automatically mean you're gonna lose all your money, not at all. It just means there's a chance things don't go perfectly according to plan. Maybe the returns are a little lower one year, or the whole plan takes a bit longer. It's about variables, not a guaranteed disaster. So, what are the actual real-world risks for a business like this? Well, the stores could just have a slow year and make less money. An expensive oven could break and need replacing. A bad economy might mean fewer people are buying coffee and donuts. And of course, there are bank loans that always get paid back before any of the investors see a profit. But here's the thing. This is where a super important safety number comes in. It's called the Debt Service Coverage Ratio, or DSCR. It sounds complicated, but look at this chart. It makes it so clear. A DSCR of 1.45 means the business makes 45% more income than it needs to cover its loan payments. That's a huge safety cushion.
It's a buffer that can absorb a lot of those risks we just talked about. Okay, so we've got your role, we've got the risks. Now let's get to the fun part. How does your money actually grow? Let's picture it like you're planting a money tree.
The whole journey basically follows this timeline. In year 1, you plant the seed. That's your $100,000. Then for the next 7 years, you get paid annual returns from the business. And then at the very end of year 7, the whole thing is sold, and that's the big payday. So during those 7 years, your money tree is actually producing fruit. This usually comes in the form of what's called a preferred return, let's say about 8% a year. Now, the key word there is preferred. It means you are entitled to get your 8% before the GP sees a single penny of profit. And if there's a slow year, it usually rolls over to the next. You're always first in line.
Then, at the end of that 7-year period, it's harvest time. They sell the entire business. And the very, very first thing that happens, you get your original $100,000 back. Your initial capital comes back to you first, before any of the big profits get split up.
And that brings us right back to that big number from the beginning. After you've collected your annual payments, after you've gotten your original investment back, and then you get your slice of the final profits from the sale, that's how your initial $100,000 could grow into a grand total of $348,000. That's the final harvest. Whew. Okay, that was a lot. So let's boil it all down into a simple, practical safety checklist that you can use to look at any private deal that ever comes your way. All right, here's what you want to see, the green flags, the good stuff. You want multiple locations, like 18 stores instead of just one, to spread out the risk. A strong, stable brand like Dunkin' is a massive plus. The deal has to be structured so that you, the LP, get paid before the GP. You want to see that healthy cash cushion, that DSCR, well above 1.2. And this one's huge. The GP needs to have their own money in the deal. We call it skin in the game. It's so important because it means their interests are perfectly aligned with yours. They only make money if you do. And on the flip side, here are the red flags, the things that should make you run for the hills. An inexperienced general partner? Big nope. Too much debt, which you'd see as a low DSCR? That's just asking for trouble. If they're not transparent and they won't answer all your questions, get out of there. And seriously, if the GP isn't putting a good chunk of their own money on the line, well, why should you? And that's pretty much the whole picture. We've peeled back the curtain on private investing. You know the roles, the protections, the risks, and the potential rewards. So I'll just leave you with this one question to think about. Is your money just kind of sitting around, or is it really truly working for you? Thanks for sticking with me on this one.